Now, private equity had a tough time during the financial crisis. What steps have you taken to ensure that that didn't happen again?
Well, the steps that we've taken managing a listed fund include maintaining a large credit facility so that if we are subject to a higher rate of capital calls than expected, so if the funds that we're investing in require more capital than perhaps the plan would suggest, we have the backup there in terms of the credit facility to meet those capital calls so that we fulfill our obligations as an investor. So that's a key point in terms of the listed company. In terms of private equity as an industry, I think managers are now much more cognizant of the risks in terms of applying debt packages to businesses. So the debt packages that we see now tend to be what we call kind of private equity friendly. They don't have the same level of I would say guardrails in place that benefit the banks in terms of being able to take control in an adverse situation. So clearly that's good for private equity. I think the industry in recent years has been very conscious of the need to sell into strength, so that assets that were perhaps purchased pre-crisis, so in the 2005 to 7 period, have largely now been realised, so they've been turned into cash. And I think we're now in a state where we're on an even footing. We're seeing fairly consistent levels of investment, fairly consistent realisations. So you could almost say the industry has normalised and we're now in a business as usual stage.
Right, and same question to you, Andrew. Obviously private equity had a hard time during the financial crisis. What steps have you taken to ensure these problems don't happen again for you?
Well, similarly to HarbourVest, Pantheon also has a credit facility in place which enables it to effectively deal with any unusually illiquid period in terms of the distributions that we receive from our underlying, so that we're always going to be in a position where we can fund our undrawn commitments because we have the backup to be able to do that. I think that generally speaking, I would echo absolutely what Richard has said about the lessons learnt in terms of the way that the managers that we're backing are putting capital structures onto the companies that they're investing in. There's a real memory of the significant financial crisis, and consequently we believe that things are structured more conservatively, that managers are taking every opportunity to refinance and push out maturity dates in order to take maximum advantage of these better times, so that the portfolio companies are well prepared in the event of a downturn. So I think there's a greater sense of conservatism within the sector. It's important also to understand that in our sector, debt is used within the context of the individual company investments, but the funds that we invest in do not themselves have debt as part of their structure. So those funds are not vulnerable in those circumstances. And similarly, as Richard has said, the structures that we run as a structure, we have a debt facility, but we don't put debt into our vehicle on a systematic basis because we believe that we can generate the returns without adding that type of financial risk. So I think that the industry is more conservatively positioned than it was before the last financial crisis, and I think that will serve it well.
Yeah, it's reassuring to hear that the industry's learnt the lessons and is more conservative in its approach.